Hey guys, welcome back to our Wealth Wizard. In today's video, we'll be delving into a crucial warning issued by none other than the legendary investor Warren Buffett. He has recently raised concerns about the potential bubble burst in the economy, and we're here to explore what this warning means for investors and the overall financial landscape. Before we delve into Buffett's warnings, let's take a moment to understand the man behind it. Warren Buffett, often referred to as the Oracle of Omaha, is widely recognized as one of the most successful investors of all time. Born in 1930, Buffett has built an impressive investment track record spanning several decades. Buffett is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. Under his guidance, Berkshire Hathaway has grown into a powerhouse with diverse investment across various industries, including insurance, energy, manufacturing, and more. What sets Buffett apart is not just his wealth, but also his ability to consistently generate impressive returns on his investments. He has a long history of making accurate predictions and insightful market observations. Buffett's investment strategy revolves around identifying undervalued companies with strong fundamentals and holding them for the long term, which has earned him immense credibility among investors worldwide. Over the years, Buffett has shared his wisdom through annual letters to shareholders and public appearances where he imparts valuable insights into the world of finance and investing. His straightforward and down-to-earth communication style, coupled with his exceptional financial acumen, has made him a revered figure in the investment community. Now that we understand who Warren Buffett is and his remarkable credibility, let's dive into the warnings he has issued regarding the potential bubble burst in the economy. Warren Buffett, known for his key insights into the financial markets, has recently sounded the alarm bells about the potential bubble burst in the economy. His warning stems from a combination of factors that have been building up over time and raising concerns among investors and analysts alike. One of the primary factors contributing to the potential bubble burst is the excessive debt levels in the economy. Buffett has expressed concerns about the increasing level of corporate and government debt, which has reached unprecedented heights. Excessive debt not only poses a risk to the financial stability of companies and governments, but also has the potential to trigger a domino effect affecting the overall economy. Furthermore, speculative investments have been on the rise, with certain asset classes experiencing inflated prices driven by market exuberance. Buffett has cautioned that these speculative investments may not be grounded in fundamental value, and when the bubble bursts, they are likely to face a significant correction. Examples of speculative investments could include certain cryptocurrencies, meme stocks, or sectors experiencing rapid growth without solid underlying fundamentals. To support his concerns, Buffett often emphasizes the importance of analyzing historical patterns and market behavior. He frequently references previous market bubbles, such as the dot-com bubble of the late 1990s and the housing market crash of 2008, as cautionary tales. By drawing parallels to these past events, Buffett aims to highlight the potential risks and consequences of a bubble burst in the current economic climate. Buffett's warnings are further reinforced by statistics and data. For instance, he might cite the ever-increasing price-to-earnings (PE) ratios in the stock market, indicating that investors are paying a premium for each dollar of earnings, which might not be sustainable in the long run. He might also point out the rising levels of margin debt, signaling the investors are increasingly borrowing money to invest, potentially amplifying the impact of a market downturn. It's important to note that Buffett's warnings are not intended to incite panic, but rather to encourage investors to exercise caution and prudence in their investment decisions. By shedding light on the factors contributing to the potential bubble burst, he aims to foster a greater understanding of the risks and promote long-term value-based investing. Signs and indicators of an economic bubble. Understanding the signs and indicators that precede an economic bubble burst is crucial for investors and market observers. By recognizing these signals, we can be better prepared to navigate uncertain times. Let's explore some common signs and indicators. Inflated asset prices. One of the primary signs of a potential bubble burst is when asset prices become significantly disconnected from their intrinsic value. This can occur in various markets, such as stocks, real estate, or commodities. Prices driven by irrational exuberance and speculation rather than underlying fundamentals can be a warning sign of an impending bubble. High levels of leverage. Another characteristic of an economic bubble is excessive borrowing and leverage. When investors take on substantial debt to finance their investments, it amplifies the impact of any downturn or correction. Instead, leverage can create a fragile financial system and intensify the consequences of a bubble burst. Unsustainable growth patterns. Bubbles often involve rapid and unsustainable growth rates in certain sectors or markets. This growth may be fueled by euphoria, media hype, or a fear of missing out, FOMO. However, without solid foundations and sustainable economic fundamentals, such growth is unlikely to be maintained in the long term. To illustrate these signs and indicators, we can refer to historical examples such as the dot-com bubble burst of the late 1990s. During that period, internet-related companies experienced exponential stock price increases fueled by investor optimism about the potential of the internet. However, many of the companies lacked viable business models and eventually saw their valuations collapse, leading to substantial market losses. Another notable example is the housing market crash of 2008. In the years leading up to the crash, there was a widespread belief that housing prices would continue to rise indefinitely. This belief led to excessive speculation, subprime lending practices, and a housing bubble. When the bubble finally burst, it triggered a financial crisis and a severe recession with far-reaching consequences on the global economy. Potential consequences of an economic bubble burst. The bursting of an economic bubble can have far-reaching consequences across various sectors and the overall economy. Here are some potential impacts to consider. Housing market. A burst in the housing bubble can lead to a significant decline in home prices, negatively impacting homeowners, mortgage lenders, and construction industries. Foreclosures may increase and homeowners' equity could erode, causing a wealth effect that dampens consumer spending. Stock market. A bubble burst can cause a stock market crash, eroding investor portfolios and wealth. This can result in a decline in consumer and business confidence, leading to reduced spending and investment, which in turn slows down economic growth. Banking sector. When a bubble bursts, the financial institutions faced increased risk due to loan defaults, asset devaluation, and potential liquidity challenges. This can lead to a credit crunch, making it difficult for businesses and individuals to access financing, thereby stifling economic activity. Market crashes. The bursting of an economic bubble can trigger market crashes in specific sectors or markets, causing significant wealth destruction for investors. This can have cascading effects, impacting investor sentiment, market stability, and overall economic health. Economic recessions. Bubbles often coincide with or precede economic recessions. The collapse of asset prices, reduced consumer spending, and weakened business investments can lead to a contraction in economic activity, job losses, and a decline in GDP growth. Financial crisis. In extreme cases, a bubble burst can trigger a full-blown financial crisis. This occurs when the instability of one sector spills over into the broader financial system, leading to widespread bank failures, credit freezes, and a severe economic downturn. Understanding the potential consequences of an economic bubble burst is crucial for investors and policymakers. By recognizing these impacts, individuals can make more informed decisions, diversify their investments, and implement risk management strategies to better navigate volatile market conditions. As Warren Buffett's warning about a potential bubble burst in the economy raises concerns among investors, it's important to explore practical tips and strategies to prepare for such a scenario. Here are some key steps to consider. Diversification. One of the most effective ways to mitigate the impact of a bubble burst is through diversification. By spreading investments across different asset classes, sectors, and geographical regions, investors can reduce their exposure to any single risk. Diversification helps to cushion the impact of a market volatility and can potentially limit losses during a downturn. Understanding and managing risk is crucial during uncertain times. Assess your risk tolerance and make sure your investment portfolios align with your financial goals and comfort level. Consider implementing risk management techniques such as setting stop-loss orders, regularly rebalancing your portfolio, and avoiding excessive leverage. Long-term investing. Warren Buffett himself is a proponent of long-term investing. Taking a long-term perspective allows investors to weather short-term market fluctuations and take advantage of compounding returns over time. Focus on quality investments with strong fundamentals and track record of consistent performance. Alternative investment options. In anticipation of a bubble burst, it may be prudent to consider alternative investment options. Value stocks, which are shares of companies trading at lower prices relative to their intrinsic value, can offer opportunities for potential growth. Stable industries such as utilities or consumer staples tend to be less susceptible to market volatility. Defensive assets like bonds or precious metals can provide a hedge against market downturns.